Hello, I'm Sam, and I'm a financial planner here at Vitality Capital Management. And today is part 2 of our 4-part series about business and taxes. And a lot of times people wonder, what is it that financial planners have to do with business owners and owning a business? There's actually a lot. We help a lot of business owners to save a lot on taxes. There's a lot of things you can do when you're being proactive with tax planning to be able to save more in taxes. And so that's exactly what we do. And some examples of that is we'll help business owners to set up retirement plans and 401ks and things like that so that they can get more money saved and do it in a tax efficient way. And also, a lot of times we will help, a lot of times people have old 401ks and things like that. And so we'll help them to roll all those into one account so it's organized and simple.
And I'm Ann Lobos, so I own a company called Northstar Consulting and Tax. So my business is pretty new, about 2 years old. I've been in this industry though for about 20 years. So Sam and I work together. And so, he does financial planning, I do tax stuff, and I actually have my Series 65 license. So I also do financial planning. But the reason why I wanted to, when I started my business, I wanted to make sure I integrated the tax in with the financial planning and the investment stuff, is because there is so much tax savings opportunity if the person doing your taxes knows what's going on both sides. So that's kind of why we work together. Today, we were laughing at the beginning because we had a little bit of a snafu. Sam was going live and he's like, how do I stop? So anyway, we have like 3 cameras sitting here. So I'm like, where should I look? So anyway, today we're going to talk about business entities and how the type of entity your business is, how that can help you save money on taxes.
Totally, yeah. And I think this series is going to be really good for you if you're thinking about starting a business, if you've started a business, because just understanding this stuff can be so powerful in helping you to save tens of thousands of dollars in taxes.
Yeah, so let's get going. This is not the funnest topic, so just hang in there with us because we're going to get to the end, because we're going to start out by just going through the different kinds of entities you can have, and at the end we'll talk about how you can save money with those entities. So just hang in there for a minute, okay? So first type is called the sole proprietor, and this basically means that you have done nothing with your business. Like the entity is just you put your website up there, maybe you put a sign out on your window that says open for business. You have done nothing legally to change your business type. The bad thing about this is you literally have no legal protection there. So if someone comes and sues you, they can get at your personal assets and all that stuff. So this is not one that we recommend. This one's kind of nice just because, like we talked about yesterday, you can file, this gets put on your personal return, so you don't have to file a separate business return. But no legal protection is not a great idea. So we don't typically recommend this. We would typically recommend that you at least be an LLC. And so Sam's going to talk a little bit about what an LLC is.
Yeah, an LLC. So an LLC is a limited liability company. And it's really powerful because it protects you legally from, what it does is your personal life, you don't want to have subject to getting in trouble from your business, and same with your business from your personal life. And so it protects you legally from the actions you do in your personal life and in your business. So for example, if someone were to fall on your steps on your front porch, they couldn't sue your business, and vice versa. If someone were to fall and hurt themselves at your business, they couldn't sue you for your personal assets. So it's just that legal protection that you're ultimately setting up. And there's also some tax benefits. We're going to talk about that here in a sec. But a couple things you want to do to make sure that you are properly and legally protected as a LLC is not to commingle funds. And what that means is, and we talked about yesterday the importance of setting up a separate bank account so that your personal funds and your business funds are separate. But also not to buy personal things with your business funds and not to buy business things with your personal funds. And that allows you to ultimately be protected and not to have that legal, have legal liability.
Well, and it's nice too if you keep it separate because it makes your accounting a whole lot easier. Like you're not having to poke through all your personal accounts to find your business stuff, right? It's right there. And if you ever sit down with an attorney, they're going to love to throw this term around. It's called piercing the corporate veil. So if you are commingling your funds and you don't have a separate business account, like even if you're an LLC, like that protection could not be there. So you think you're protected and you're not. So.
Yeah, and ultimately, if you're going to set up an LLC, we recommend that you seek the advice of a legal professional, because oftentimes these can be complicated to set up, and you have to structure it right so that you're actually legally protected. And so seek that advice when you go to set these things up.
Yeah, because Utah will let you set this up on your own. They've got something called the onestop.
Business shop or something.
He looked it up before, and then I can't remember what it's called, but onestop something. But if you have more than one owner, I very highly recommend going to an attorney, because you may like your business partner right now, but down the line, if you guys get in a disagreement and you didn't have an attorney help you set up that your LLC agreement, like you could be hating it because you keep fighting over stuff that like could have very easily been not an issue if you had your stuff set up right from the beginning. So.
Totally. So how do you file your taxes if you are an LLC? It kind of depends. If you are a single member, or you're the only owner in your business, then you're going to file taxes what's called a Schedule C, and it'll just be part of your regular tax return. If you are a partnership, though, you'll have to file your own separate tax return for the LLC, and then as well as your personal tax return.
Well, and the interesting thing is, like, when you have to file your separate return, like they don't have a return called an LLC return. It's actually called a partnerships return. So you look at it and think, well, I'm an LLC, I'm not a partnership. But, well, that's just the way the IRS made it. So.
So the other thing, too, is a C Corp or a C Corporation. And oftentimes we won't recommend this to people unless they're looking to raise a lot of capital in the future. That's really the only time. But most small business owners, they're looking at an LLC or an SCorp.
Yeah, I don't see C Corps very often. I used to see a lot more before the LLC came along. But now that the LLC is around, that's usually the chosen one that people start with.
Totally.
So the other type of entity is what's called an S corporation. And you've probably heard the term S Corp thrown around. That's kind of the abbreviation for it. So if someone comes along and says, well, I'm an S Corp, like this is actually just a tax move. So it doesn't change your underlying entity. So you either still have to be an LLC to begin with, or a C Corp. And then what happens is, for tax purposes, you go and fill out an election and send it into the IRS to become an S Corp, and then you get taxed differently. And so the benefit to this is that you can save some money on taxes, and we'll get to that in just a second. But you have to file a separate tax return with an S Corp. So even if you're the only owner, you still have to file a separate tax return. So that's kind of a little bit of a downfall where you might have an added cost there with the extra return. But the benefit of this is that you can have some tax savings, and the way that happens is through how the taxes are calculated. So Sam's going to talk first about the first level of tax, and then I'm going to talk about another level, and that's where the savings come in with an S Corp.
Yeah, so there's kind of two main levels of taxes, and the first level is just basically your income tax. And based off how much income you make, whether it be your employee or your business, you're going to be taxed at a certain rate.
Yeah, and then as a business owner, you have another layer of tax, and it's called the self-employment tax. Now, as an employee, a W-2 employee, you're already paying part of this. Like on your W-2, you've got your gross wages, and then you've got your federal withholding, and then your FICA tax, or your Social Security Medicare tax. That's self-employment tax. But as an employee, you're paying half of that, and then your employer is paying the other half. So when you own a business, you're now responsible for paying both parts of that. And that self-employment tax ends up being typically about 15%. Now, if you're a sole proprietorship or an LLC, you pay self-employment tax. So you not only pay your income tax level, but you pay self-employment tax on all of your income. So say you made $50,000 from your LLC or your sole proprietorship, you're going to pay a self-employment tax on that, 15% of that. Now, if you're an S Corp, and this is where the savings come from being an S Corp, is that you can decide what a reasonable wage is, and then so say you made $50,000 and you decided that a reasonable wage was $25,000. So then you only have to pay that 15% self-employment tax on the $25,000, and then you basically have $25,000 that you saved 15%. And Sam's going to totally do it on the calculator because I do not do that in my head.
So if you took 25,000 and paid yourself, then you would save on that self-employment tax, which it would equal $3,750, which is huge tax savings.
I know. I am sure that you can think of something better to do with $3,750 than to give it to the IRS who's just can't waste it.
And that's only on 25,000. So you can see as you make more money, this can be even more advantageous.
Yeah. So that's kind of the cool thing about an SCorp. Some of the downfalls again is that I mentioned that you have to file a separate tax return, so you have the cost of that.
Yep.
And then you have to run payroll, so you have to actually set payroll up in your business, and so you are going to get a W-2 from your business at the end of the year, just like you're the employee of the business. So you've got to get that set up. So let's just chat for 1 second about what reasonable wages are, because that is what the IRS defines as what you need to pay yourself in an SCorp. And like a lot of the things that the IRS talks about, it's not clearly defined. Got gray areas there, and so what you want to do with the reasonable compensation is you want to decide what you would need to pay someone to do what you're doing in your business. So, but here's the caveat, is that you don't have to say, well, I would have to go hire a full-time person and I would have to pay him $50,000. You don't have to do that. You can say, because we all know as business owners, we're wearing about 50 hats, right? You can say, well, I usually wear the marketing hat for, 2 to 4 hours a week. And I wear my accounting hat for like 2 hours a week. And I wear my salesperson hat for maybe like 5 to 10 hours a week. So then what you can do is you can say, well, if I went out and hired a marketing person just for that 2 to 4 hours a week, what would I have to pay him? Maybe I'd only have to pay him $12 an hour. Maybe you can find an intern you could pay, whatever, $10. I don't know. So, and then your accounting, let's say if I went and hired a bookkeeper, maybe I have to pay him $15 an hour, right? So you can break what you do in your business up into those pieces, because the goal is that you want to get that reasonable compensation down lower, typically. That's a caveat, but typically you want to get that lower, and so, but you want to be able to justify it, because this is the number one reason why S-corps get audited, is because of reasonable compensation. So you want to be able to have some backup on that.
Yeah, so if you don't want the IRS auditing you, you need to make sure that you do have reasonable compensation for that portion that you're taking and paying self-employment tax on.
Yeah, so that's the caveat there, and then what's next?
So the other thing we're going to talk about is a lot of times when you go to set up a business, you're not sure, what I should set up. We've obviously talked about all these different corporations and LLCs and S-corps, but you're not sure what to set up or how to set it up, because you're not sure, like, based on how much income. And a lot of times when you're just getting started, we'll recommend that you set up an LLC, because that can oftentimes be the cheapest. And then later, as you start to make more and more money, it could make sense to do the S election. And what that'll do is it'll get you out of that self-employment tax, and it'll save you, although it is more costly to file those tax returns, you'll save a lot more because of the taxes you won't have to pay through self-employment tax.
Yeah, and then it also gives you the flexibility, because sometimes people are like, well, why don't you just always want to be an S-corp? Well, as is the case with a lot of tax stuff, there's always exceptions, because sometimes you actually don't want to be an S-corp. Like, I have a client who, he has his business and he has a W-2 where he makes really good money at the W-2 job. So it's over the FICA, the Social Security limit, which means that he's not having to pay Social Security tax anymore. He's only having to pay the Medicare tax, which is like a percentage and a half, like 1.45 or something. So he's not having to pay the Social Security tax on his business anyway. And there's some deductions that are available that are more beneficial if you're not an S-corp. So the caveat is that you don't always want to be an S-corp. It's kind of a case-by-case basis. So hopefully you have a good tax person that you're working with that can help you do an analysis on that. And one of the things that we do with our S-corp businesses that I'm actually just adding in for this next year is that I always do a tax planning session at the end of the year, but I'm going to add in a reasonable planning session too, so that we can make sure that they're starting out the year with that compensation and being able to carry that through the rest of the year to make sure we're optimizing those tax savings. And the other thing too is that sometimes, we talked about, you want your wages to be lower in an S-corp, but there are some times when you don't. Like if you're trying to maximize your retirement contributions, those are limited based on what your W-2 wages are. So if those are really low and you're trying to put a bunch of money in your retirement account like plan, then that's not going to work. So there's always kind of this case by case thing of, you know, what you're actually trying to accomplish in your business. What are your goals?
Yeah, no, it really does all come back to your goals. And ultimately, like, these videos for educational purposes only. So we just advise you as you're going through all these, trying to figure out what you should and shouldn't do with your business, to seek the advice of a professional that can help you, a tax professional, a legal professional, that can help you to know how to do it and how to structure things so that you can ultimately get to your goals faster and more efficiently.
Yeah, and one of the things that we do that's super fun is that we do a free tax analysis. So if you're kind of wondering, should I be an SCorp, should I not be? We do you can send your stuff to us, we can look at it, we can have that conversation and see, is this going to be beneficial for you or not, so.
Totally. That was our video for today. Tune in next week for our part 3 where we will, we'll talk about, so today we talked about the entity types and how they're taxed, but next week we're going to get in the nitty gritty of taxes and deductions and make sure that you're not missing any deductions as a small business owner.
Yeah, because I see a lot of common deductions that are missed, so we're going to get to talk about that next time. So,
cool.
see you later.
Have a good one.